Welcome to The Dealist, your insider's guide to navigating the complex world of M&A. Today, we're going to take a deep dive into the IPO world and find out what makes a good IPO. For that, I have been joined by Louis Lehot, partner with law firm Foley Lardner, and Michael Golomb, CFO with blockchain technologies provider Blockstream. Guys, thank you so much for joining me today. Louis, can I ask you for a few words of introduction about yourself so people understand where your expertise when it comes to IPOs comes from?
Well, good morning from Silicon Valley, Catherine. I'm Louis Lehot. I'm a Silicon Valley lawyer, and I've been practicing for almost 30 years. And what makes me excited every day is I get to work with people like Michael on the hardest problems they have. And I'm excited to talk about IPOs today because as we go to recording, it's March the 8th, 2026, and we have never seen such a crop of exciting technology companies ready to take us public. And so I'm really looking forward to the discussion today, Catherine, and thanks for having us.
Thank you so much. Michael, just a few words of introduction to the people that don't know you.
Thank you so much for inviting us for this very exciting podcast. My background and my career, I've taken two companies public, both in New York and London, multi-billion-dollar IPOs in various industries. I also was a chief financial officer for a few publicly traded companies, and I was a joint venture partner with Morgan Stanley Special Situation Fund. Stanford GSB graduate, CPA, excited to participate in the event today.
Fantastic. Thank you so much. Now, Louis, you set us up quite nicely. There's an awful lot of activity. There's an awful lot of optimism when it comes to the tech space and potential IPOs. Could you set the scene for me a little bit for those people who aren't as deeply in the matter as you are? What should we be expecting when it comes to the IPO landscape in the next, say, 6 to 12 months?
Well, even before we were rocked by the AI revolution of the last 2 years, we had a crop of really great and large public technology companies ready to go public. And notably, I'm thinking about Stripe in the fintech space. I'm thinking about Databricks in the big data and analysis space. But really, in the last year or so, we've seen just a rapid acceleration of AI hyperscalers raise gobs and gobs of capital, whose investors really need to see a public listing in order for them to hold on. So I think we really have a combination of factors that brings us to today's reality that we've got a great crop of companies ready to go public. Now, post-COVID, we had really an adjustment period as interest rates rose and the market needed to adjust to the new cost of capital for both equity and debt. And I think we've had a couple of years now for that to stabilize, and so that's knocks out what I'll call headwind number one. Headwind number two really was disruption uncertainty. And so first we had the disruption of who's going to be the next president. Then we had a new president. Then it was Liberation Day. Then it was every day it's something new. This morning I wanted to share a funny one for you. The market has had a crude awakening. So there, lawyer humor for you. But I'm looking forward to the discussion, Catherine.
Great. Thank you very much. Michael, just share your thoughts with regards to expectations of the IPO landscape going forward.
Well, Catherine, before we go there, actually today is a monumental day from the Bitcoin blockchain community. Today, exactly 20 million coins have been minted out of 21, and it's a big milestone for a lot of folks in my industry. So this is many folks are discussing how instrumental this date is and how this can progress as we go towards the other public markets. But let me answer your question. From my perspective, the IPO market has become much more selective over the last few years. Capital is still available, but investors are demanding stronger fundamentals, clearer profitability path, and disciplined governance.
Yeah.
What we are seeing now is a shift away from the growth at any cost. As you remember from .com days or 2007, 8, or 2021, people cared about revenue. I think it has shifted, and now we're moving towards that business model, stronger unit economics, credible leadership teams. Another trend that companies are staying private longer, which means that they do eventually go public. They will usually be larger more mature businesses with substantial revenue with global footprint.
Okay, thank you very much. Now, I'd like to move this on and start by addressing the really big question, which is, why should a company pursue an IPO? And both of you come to this from a slightly different perspective. Michael, you have accompanied a number of businesses as an executive through an IPO process. And Louis, you've obviously advised a variety of clients on going through an IPO process. Maybe I'll start with you, Louis. Talk me through, when you first have the conversation with your clients, what do you need to establish? Why are you actually pursuing this IPO? What do they need to tell you for you to go, do you know what? Yes, an IPO is exactly what you should be doing. Or on the flip side, are there situations where you've turned around and said, do you know what, guys? I don't think you're quite there yet, but do X, Y, and Z, and we can get you there, and we can pursue a successful IPO in a few years' time?
Great question, but let's be truthful. In the United States, over the last 20 years, the cost of going public, the cost of staying public, has become so large, the risk so significant. And at the same time, back in the private markets, there's never been more capital available. There's never been a group of investors as strong. And so really the primary path now for any company is to stay private. And going public now is an alternative to do one of two things. Either you're going to need the public markets to raise capital, which again is it's a pretty rare scenario because the private markets are so deep, or it could be a vehicle of getting liquidity, and that could be getting liquidity for the founders or for the employees. And the private markets have found ways of achieving those goals as well without a company going public. So think about, I'm going to pick on Stripe as an example. Here was a company a few years ago where the bulk of the employee pool was reaching the 10-year expiration period of their options. And so really those employees were militating for some kind of solution because they had cheap priced options that were literally going to expire if the company and the founders didn't take it public. And so what the founders and the company did is they found a private investor who was willing to come in and do tender offers to the employees whose options were expiring. And pretty much every year now, there's a tender that they organize with new private money that comes in to absorb, to provide capital and exit to those employees whose options would otherwise expire. So as you see, the private markets have stepped in again with a solution. And so who is it that's going public and why? And I want to revisit that question before, but first I want to give Michael a chance to answer.
Okay, Michael, maybe you can pick things up there. One thing that I thought Louis raised that is really, really interesting is this sort of notion that there are different stakeholders and they all have different agendas and want different things out of a liquidity event such as an IPO. But maybe you can talk to us about, this whole idea, why pursue an IPO when actually, as Louis said quite nicely, the private space is much more comfortable in many ways.
Absolutely. I completely agree with Louis' feedback. I'll just reflect on my personal experience as an operator, taking a couple of companies public and sometimes actually advising my companies not to go public. So what are the pros and cons? Let's say an IPO it's very transformational. It provides access to permanent capital, increasing brand visibility, right? It creates liquidity for early investors, employees. But there are significant trade-offs from my perspective. Public companies face intense scrutiny, quarterly reporting pressures. For example, once you become a public company, you're now living by by different cycles, not necessarily based on your business cycles, because you got to report on quarterly basis and make sure you do a good job quarter after quarter, right? And regulatory requirements. There, as Louis just pointed out, significant costs from legal to audit. Now, decision should be just, can be an IPO, but rather should be IPO at the point of our life cycle. Now, key consideration that I would think to me is three big ones. One, does the company have a scalable business model and compelling equity story? Second one, I would say, do we have an operational infrastructure, finance, legal governance to operate as a public company? As Louis pointed out, it's very expensive to do that and to be a good citizen. And finally, third one, Are your major stakeholders aligned? That includes founders, investors, and management team. Now, misalignment here can create problems, and I've seen it in my own life. Now, your question was about key stakeholders.
Yeah.
The key stakeholders go well beyond just management. For example, you need alignment across the board, founders, venture investors, independent directors. Some people forget about them sometimes, and Louis and I have examples of that. Bankers, lawyers, auditors, eventually the public investors who own your stock, right? The most successful IPOs are when all the shareholders are aligned, stakeholders, I would say, are aligned around long-term vision rather than a short-term liquidity event.
Yeah.
So that's just in the summary. There are other things we can discuss, like for example, picking the right advisors, right, that to help you. But I'll pass to you.
Great.
Well, let me go back to answer the first question of why go public at all. And again, just setting the table. The idea of going public is that you would have financial statements that have been vetted and approved by the Securities and Exchange Commission. And so there is no better marketing vehicle to sell your company than to have an S1 on file. Two is to provide some mechanism for stockholder liquidity. And I think we've talked about the fact that private markets have come up with alternatives, but really the traditional reason was to have a place where stakeholders, whether it's the founders or line employees, could receive equity and sell it. Three is allow other key investors, your venture, your private equity sponsor, to go have an exit. Four, it's to create some kind of a currency for future acquisitions other than cash. So to buy companies using stock, the best way to do that is with public stock, although private companies, again, have been learning how to do this using their own stock as a currency. Having access to the U.S. capital markets for future financing of any kind, whether it's a convertible bond, high yield debt, equity of all shapes and sizes, it's the validity of a public market listing like the New York Stock Exchange or the NASDAQ to recruit and retain globally minded executives who are going to want the listing as an exit for their stock, to attract key employees, to present yourselves to your customers and suppliers in the business and commercial context as a leading company. Having a listing is very helpful for that. And it always used to be, Catherine, that you would get the best valuation in the public markets. And once again, that's now no longer necessarily true. So those were all the reasons to go public. And again, I think that in the United States, we've turned things upside down, and being public has become so risky, expensive, and difficult that companies would much rather remain a private company. And we can continue on with the example of Stripe, where I think it's been ready to go public for at least 7 or 8 years, and the Collision brothers have found a way every year to remain private because they can. And so I'm finding increasingly that when I talk to companies about whatever it is their objective, which is usually not to go public or to stay private, it's either to raise capital or to obtain liquidity for themselves or for some other key stockholder. And we first go to the private markets, and it's only then that if we fail to raise money in the private markets that we look at the public markets. And that is a fundamental change in how companies operate, which has happened. It just sort of crept up on me over the last 10 years, Catherine, until finally, maybe 5 years ago, it became obvious, oh my gosh, the public markets are the backup plan.
Yeah, I like that.
Michelle, I'd like to point out also, just to add to Louis, what you just meant, you remind me about something that people don't talk about a lot, who have not gone through process of you and I have gone through. IPO could mean different things to different people. In reality, going public, that's the term that we use, because initial public offering is when you're filing S1 in the United States and you're going public. But there are other ways to become a public traded company, right? You can go through RTO, which is reverse takeover, when you go in buying another company and you're taking over their management and you take over their company. Through SPAC, we'll discuss it later, right? And also being acquired a public traded company. There's a lot. Louis, you just remind me of a good example where some companies going through the whole IPO process and then to be going through, then to be right before listing to be acquired by another company. And by going through this exercise, they're pushing their valuation to that level to push the other company to come back and say, okay, fine, I can see that you have this demand, I'll pick you up for that price. For many founders, that's actually a good opportunity because once you become a public traded company, you are in a blackout period where you cannot sell your shares. Through the M&A process, sky's the limit, right? So we can talk more about that, but I just wanted to identify that also additional matter. So
no. Absolutely. I think you both make a really interesting point there that, there are other options of addressing some of the concerns that people think that they are possibly addressing via an IPO. But let's go sort of along the timeline of our hypothetical scenario. We've got a company and they've gone through the whole process of saying, would we like to consider a listing for these reasons? Would we not like to, the pros and cons? And we're now at the stage where they've said, yes, actually, we think that the benefits of an IPO are what we would like to reap. When is actually a good time? Because there are obviously timing considerations that we need to factor in. There are things that the company needs to have in place, considerations that it needs to have taken, protocols, people that it needs to have employed in order for it to go through an IPO process. Michael, maybe I can come to you on this one first and ask you to sort of talk us through at what stage you felt, okay, this is what we've done and we are ready to do now. How did you prepare the company for a listing?
A very, very good question, Catherine. So from a technical point of view, it's not that difficult to go through this, through the process and putting together the paperwork with SEC and everything else. But that's not, some people forget the IPO or becoming public is just the beginning of your future and it's not the end. So to me, if I were to work with a company and advise them, to me, the company needs to demonstrate past and future growth. Investors want to see two things: evidence of execution and confidence future growth. Historical performance proves that you can deliver, right? But the valuation really comes from your ability to articulate how the company scales from here. And you need both in this case. Now, the equity story. I like to call it rainbow with a pot of gold, right? Sometimes we joke about it. Actually, I like this metaphor. A strong IPO story shows a clear path from where the company is today and to where it can realistically go. Investors really, in today's markets particularly, want to see the credible strategy for expanding markets, improving margins, right? Launching new products or entering new geographies. It's about showing that the best chapters of your company's future are still ahead of time, right? And that's why people are trying to get into the IPO companies, because they believe there's a growth potential. And finally, do something well, but show next steps. Companies that go public successfully usually dominate a particular niche. Yeah. But they also demonstrate how the niche becomes a platform for something much, much bigger. New products, new markets, new technologies. The public markets rewards companies like that, and which are focused and ambitious.
Okay, thank you so much. Louis, can I bring you in? Can you, first of all, tell me, do you agree with what Michael has said? And then second of all, do you want to expand and give us our thoughts on that topic?
Yeah, no, absolutely. So I start to talk about IPO, Catherine, in the context of what I know is either a large financing that the company needs in terms of to finance its future growth, or there's some group of stakeholders around the table that's looking for an exit. And getting ready for an IPO is the best preparation for any outcome. Yeah. So I think it's a great idea to prepare, even if it's not something you want to do. Again, it is the best door opener for the things you want to do, no matter what they are. Okay, so in an ideal world, we would have 18 to 24 months to go get ready for this process. And I really, what are the signals that I think we need to get ready for this process? And I think it's at least $10 million of revenue if you're not a life sciences company. If you're a life sciences company, this is a totally different ballgame. But if you're in technology, which is where Michael and I live, or in some traditional business, you're going to need at least 10 million of revenue, and ideally 100, and in a perfect world, it would be somewhere between 3 and 500 million of revenue. And the bulge bracket bankers will tell you that that's the right place to go. The second signal I see, Catherine, is 8 quarters of quarter-over-quarter growth. And you can have a drop in one of those quarters as long as it's explainable. There was a customer who unexpectedly churned out, something like that. But 8 quarters of consistent growth. But just as importantly, Catherine, you need to show the analysts that you're able to forecast 8 quarters in the future and what they look like. So 8 quarters backwards, 8 quarters forwards. Now, in terms of getting ready, so those are the signals. In terms of getting ready, I think you have maybe 8 legs of a chair here, and the first leg is what Michael does, and that's the accounting and financial function. And you're going to need to have a very strong control function and forward-looking function. So somebody who can report the past and who can forecast the future. The second thing is you need to have your legal structure in place. And so for some companies who are selling product around the world, there's ways of structuring your business in terms of entities and which entity is selling what to whom, and making sure that your contracts with your customers are in place. The next stool I would say is in some sort of an internal audit function, so that there's somebody checking that the work is correct. And obviously there's an internal part of that, but there's also external, and that's coming in and having an audit of your financial statements. And you're going to need at least 2 years of audited financial statements, and really ideally 3 in order to go public. The next part of the stool I would say is tax analysis and planning, and some way of really showing that you've looked at all your revenues across the world and you've placed things in the right place in terms of do you have an IP licensing entity, for example, and is it in the right jurisdiction? It's having a technology and cybersecurity infrastructure that's ready for the attention that you're going to get as a public company. It's having an HR function that knows how to compensate people. When you become a public company, everything is in the headlights. And so, do you have rankings and grids, and how do you do that? And finally, some sort of an enterprise risk management or ERP system where the company is really capturing all the levers of the business so that they can track them on a quarter by quarter basis. So that's putting in software that enables all of those factors to get reported up to somebody like Michael. So I've said a whole lot of things there in terms of how to get ready, but that's an 18 to 24 month process really. And you're going to need a world-class team, back to one of your questions, to put that in place. And so that's not only Michael as your CFO, but it's also bringing on his controller and his FP&A guy or gal. It's also bringing in a world-class general counsel who can put that legal structure in place and make sure the contracts are papered, and it's making sure that the HR and executive compensation plans are optimized for growth. It's having an investor relations function that's managing those relationships, and I'm seeing that role increasingly happen in the private company context, given that as I've been saying, we're having so many layers of private capital come in. It's also building a board of directors that's not just your VCs from when you first raised capital 10 years ago, but it's also, as Michael said, independent directors, people who can bring in that special expertise that the company needs, whether it's somebody who can help the salesperson unlock a repeatable wash, rinse, repeat cycle, or it's somebody who, if the company is in a regulatory area, who can unlock whatever regulatory roadblocks there are. It's having an ex-CFO to be the chair of your audit committee so that there's some check on the financial functions. So those are all things that we talk about when we're doing a pre-IPO exercise, which, as I said, is designed to capture now private capital or a complete exit rather than an IPO. But to be ready for the IPO, you need to do all those things.
Now, listening to you there, Louis, I mean, lots of the sort of the functions, the processes, the departments that you talked about, one would hope that a company has those as well. But am I right in thinking that it's an exercise in having all of them and having all of them working at the highest professional level. So it might be a case that you need to sort of tighten things a little bit. So yes, you've got an HR function, but you need to really, really get on top of all those contracts. You need to have an audit committee that is reflected throughout the business and that does everything on a very, very high level. Is it fair to say that there are very few companies that will come to this having to build everything from scratch? One would hope that a lot of those functions are already there, but just need to be upscaled and upskilled a little bit. Is that fair, or is that not quite right?
I think that's a better function for Michael. I'm just the outside guy, the lawyer, looking in, describing a perfect world. But one of the great things about working with Michael is I've seen him upskill, up-level generations of companies by bringing in better people. But I think it's a constant process. But Michael, you should take that.
Michael, tell me, I mean, when you started it, bear with me, when you started it, were you really starting from scratch in some of those departments, or was it a case of like, yes, we have an HR function, but we need them to work a little bit better? Yes, we have an audit function, but we need them to talk us through how much of this was really starting from scratch.
When I was listening to Louis to speak to answer your previous question, I was smiling inside. I was like, that's why I'm working with Louis, because Louis knows every single component to the death. And then there's so many attorneys who are really good at what they do, but they're focused on what they do and they don't cross the lane. Where Louis actually understands the whole thing. I was smiling inside. I'm like, yes, Louis, let's go. But anyways, in my experience, working in the various companies, sometimes is through change management is required. Sometimes is through full-blown restructuring or through some kind of acquisition or merger. Like Louis and I work today at a public company back in 2017 to 2019. There was a public company in New York where we had to restructure fully complete the company because of certain internal compliance issues, right? So there's a lot of things going on, but just to say, every situation is different. You never come to something that is specifically the same. To me, IPO timeline rarely go exactly as planned. I have never seen anything that comes the same way. My day starts one day with one schedule, and 10 minutes later, fire drills and things go sideways. Now, what's important is the market windows open and close quickly. Regulators may ask unexpected questions. Investors may change their assumptions. The teams that are successful are the ones that stay flexible and prepared. And it's what the experience cannot be forgotten. This is not a game to allow people to train themselves. You got to feed people need to come into this exercise with at least one or two examples successful examples in the past. Sometimes those examples, when I'm saying successful, doesn't mean the company gone through the IPO. Sometimes taking the company off the market is also the right step for the company. In many companies, like I know we chatted before about triple track process, right? Many companies today run a triple track process, preparing simultaneously for an IPO, strategic sale, or private financing. That creates optionalities and strengths, our negotiation positions. For example, the company that have taken public back in .com days ended up being sold to one of our investors through the process of the going public, right? And led to a good M&A experience for our investors. Upscaling the team. Going public is not just a financial event, as Louis just pointed out. It's an organizational transformation, period, point blank. You need a strong public company finance leadership. You need investor relations capabilities, compliance functions, internal controls. And let's not forget, this is just the back office. We need a strong business model that supports the growth that Louis pointed out earlier, about 8 progressive quarters, being able to discuss correctly and explain to analysts your future and why you want to be public. If they're not sold, it's going to be very hard to maintain the stock and everything else. And then so that's how I would reflect on that question. Yeah.
Okay, super. Thank you very much. Let's take a quick break there.
Deal Center AI is the smart choice for next-gen deal making. You can send requests in just seconds. With Deal Center AI, there's no more complex setup and no delays. You can skip registration and account setup and move on to more important tasks. Track progress and prioritize tasks instantly, all with a single click. And with Link, our powerful AI engine, Potential issues are flagged in real time, so your deal setup is faster, smoother, and backed by AI-powered insights. Intralinks. Go forward.
I'd like to move on now and spend some time talking about the use of AI and technology in an IPO process. Can you share some of your insights and your experiences when it comes to that? I'm specifically thinking about the use of AI to cut out some of the cost of an IPO process. Michael, talk me through how have you guys used it when you were preparing for an IPO process in your previous companies that you worked in?
So technology is playing a much bigger role in the IPO process today. In the past, I did not use AI tools because they recently have become available to us, right? AI tools can definitely help analyze large data sets, right? Streamline due diligence, assist with financial forecasting, help me sometimes with the deck presentations for the board. Louis and I sometimes put them together. But just as important is the secure data management, especially when the multiple advisors and regulators need to access sensitive information. Technology helps make the process more efficient and secure. And to me, I would not really necessarily put a big emphasis on AI unless this particular technology can support my business, operational business. Louis, what do you think about that?
Yeah, Louis, what about you? Can you share? I mean, is it something where clients are coming to you and are saying, do you know what? We would like you to use AI. We would like you to use it in this capability. And we would like that to be reflected in the fees that we're paying you, because this is something that came out specifically in our season 2, where we looked at AI and the use of AI in an M&A process, where people said, yes, we see our clients wanting us to use it, but we also see them saying, we want there to be a reflection in the fees that we're paying that you are using AI.
It's a great question, and Michael, hold your thought, and I'm sure you'll have a way to improve my answer. But Catherine, the truth is, as we record this podcast on March 9th, 2026, we are in the early innings of implementation of AI technology tools inside of companies. It is the first inning, maybe the second, and I'd say it was about 6 months ago. I realized that every single client in every single scenario needed to hear from me in the initial client onboarding discussion or in the pitch even, that we have AI that's leading edge, that we use it, how we use it, the guardrails against how it could go off the rails, and finally, what are the cost synergies that the client gets. So I think clients want two things. They want better delivery and they want lower price points. So those are both things that we have to highlight in every new engagement, especially in IPO engagement. The truth is Catherine, is that we still haven't yet arrived at a place where AI is driving an IPO process. That's the truth. People can make long speeches about how it's going to change how we do everything, but we're just not there yet. But I think Michael said it right, that the first thing that we can use AI to do is accelerate the process of due diligence. And obviously AI and large language models are ideally situated to review, summarize, and find problems in terabytes of data. So if it's unsigned customer contracts as an issue, if it's an MFN that one customer had that's going to put in doubt the rest of the stack of customers and whether the revenue was rightly recognized at the amounts that it was. I think that we're just seeing the beginning of a process where AI is going to help us draft disclosure, and I certainly would not say that I write disclosure with AI, but let's face it, I'm using AI to make sure that my disclosure is complete, and that I haven't forgotten anything, or that I've used the best turn of phrase. What I'd like to see in the future is some way of using AI to make sure that we have really canvassed every investor, because I think one of the differentiators that banks offer is access to customers, and I think that really building the biggest book possible in your book build process is really a driver to a successful IPO. If you're selling $100 million of shares in a transaction, any bank is going to tell you that they need to have demand for 300 million. They need to 3x the book, if you will, the book being the amount of interest that they have, so that when they go out and sell 100, you're going to have a healthy trading market where people don't just dump it as it goes up, but that there's a whole group of people that are trying to build positions. And so a smart banker, when they have 300 million of demand, will cut back everyone's allocation to a third. And so they know that, XYZ asset manager asked for 10, we gave them 3, so now they're out in the aftermarket looking to build their ideal position for an additional 7. They're natural buyers, right? Yeah. I think AI could really help there. And there's just so many parts of the process that I think would benefit from automation. But somebody like Michael is so much better situated to tell us.
Yeah, let me give you a couple ideas. Three immediate ideas comes to mind. Number one, when you're writing SEC filings, right? Just risk factors. I can just go and use AI because nobody writes risk factors from the scratch, right? We sometimes copy, borrow from other friends in the market, right? So by having this instrument, by identifying those comps, that will simplify about 300 pages of your prospectus, right, Louis? So that will also help us to adjust this and also to create the right narrative for those risk factors that are applying to our company. That's number one. Number two, investor relations. Once you go public, writing script for CEOs and CFOs, preparing for analyst presentations, rewriting financial model. Right now, for example, internally, we're using AI to build our budgets and forecasts in analytics already with a programming language which identifies specific conditions. We do comps analysis. We're using AI to do sales commission plans for our salespeople, depending on the stage of the product and company availability. And finally, you can use also for I'm spacing out on one last item I wanted to mention, but it helps to do when you do find the last step after you go through public offering, and people sometimes forget that the last very minute is what do you do allocation of the if you're oversubscribed and how you allocate investment among your investors, right? Yeah. And look what Louis just pointed out. I've been through a few examples where investment bankers they try to put, when there's oversubscription, they try to give those extra allocations to their friends and everybody else because that's how they make money in the future. They help you to do your deal. They tell you they're with you, but in reality they are with their investors because they need to work with them in the future. So the AI tools can eventually help you to allocate correctly the round through the public offering, and also the green shoe, how this will work, right? So there's a lot of different ways you can play that. But again, I'm getting into too many details. Maybe it's not important for our audience right now.
No, that was very interesting. Thank you very much. Now, I'd like to pivot slightly. And while we're spending an awful lot of time talking about the mechanics of an IPO, what makes a good IPO, when to IPO, the important thing, I guess, to remember is that the IPO process, like an M&A process, is not actually the business. And companies will have to navigate and balance and find a way to balance that, on the one hand, preparing for an IPO, making sure that all the documents that you need, all the people that you need are ready and good to go, but at the same time not losing track of what it is that makes the business successful, that makes it an interesting business to work with, all those kind of things. Michael, from your experience of having prepared and having gone through that process a couple of times, tell me, how did you manage sort of team fatigue? How did you manage people, or how did you organize it? There were people who were actually focused on doing whatever it is that the business did, while another part of the organization was fully focused on preparing for an IPO. Just share some of your sort of personal experiences there.
Absolutely, Catherine. This is a very good question, and sometimes people don't think about that. It takes a certain person to go through this exercise, and it's because in addition to having a full-time job, you have another two full-time jobs that we doing going public. So one of the biggest mistakes that companies make is letting the IPO process distract from running the actual business. And that's very important because when you have roadshows, we have meeting with analysts, when they all want to meet with the management team and the top folks, that process takes away from running the business. Public investors only invest in performance, not just the story, right? As we know.
Yeah.
So the management team must maintain focus on revenue growth, customers, and execution while the IPO process runs in parallel. Also, it's important to manage the fatigue. IPO preparation can be extremely demanding. I have seen people burn out left and right. Sometimes people quit after the IPO process because they're having issues at home with their spouses, and so it's very, very important to be straight. So on one side, it's relatively straightforward. People know about this. On the other hand, what I've seen in my career, people still back office does not get enough resources from the business to create this extra support. And that's what it becomes when you have that's when it happens to where we have to rely on the right advisors like Louis, for example, who will do whatever it takes to get the job done and will provide advice and give me resources for me to get plan B, plan C, plan D. Sometimes just having specific bonus systems and everything else to push people to do what they need to do. What I've learned in my career is that you got to surround yourself with the best team members, 8 top personalities, like running a basketball team and going for a championship. And that's basically kind of what it is. Louis, I don't know, I'm not opening any new stories here, but I think it's a very tedious project. Not every single, I would say 90% of people in finance or back office don't get to do this project in their lifetime. So it's for a specific crew of people who know how to get it done, and it's just a process where you have to continue going forward. Louis, I'll pass back to you.
Well, before we come to Louis with this one, I think it's really nice the comment that you made that you need to be really upfront about it. You need to be aware what it is that you're letting yourself into, and that it will require resources. Louis, a few thoughts from your side on the issue of balancing running the business and IPOing, and not getting one get in the way of the other.
Well, I like to tell my clients that they can leave it to me, the IPO process, and they should just do their day jobs. But certainly, when you have an IPO process, it's going to demand a lot of your time. But the key, as with all things, is surrounding yourself with a world-class team, and those are both your direct reports and your external advisors when you need it.
Okay, fantastic. Now, before I ask you both for some war stories, I feel that I can't have an IPO podcast and not talk about SPACs. And Louis, you're grinning at me there, because I remember when we first had the call about this, we were both saying they will just not go away. They're the kind of thing that just comes back over and over again, no matter how many times we say they're not going to happen anymore. Why won't they go away?
Well, I think that capital, as long as it's abundant, will find ways of being deployed. And so really think of a SPAC as just another vehicle for financial sponsors to find great companies to acquire. But in this case, they raise the funds in a blind pool in the IPO market, and then they acquire an operating business that's private, and the private company inherits the public listing of the SPAC and the capital, and the SPAC gets an operating business. So why does it keep coming back, and why does it keep coming back in new ways? So I think there have been 4 principal waves of SPACs, and I'm not going to go back and give a history lesson on all those different variations, but in each case the market crashed because of some perceived defect in the structure. And in the last SPAC crash, which happened post-COVID, I think there were several reasons for the crash. One is that there were so many SPACs that the quality of operating company that they brought to the public markets just wasn't up to snuff. And as I said, if you can't look forward and see 8 quarters of growth, you shouldn't be a public company, period, full stop. And secondly, there in the structure, there is so much demand to sell the stock that there's just so much downward pressure that it's very hard for a SPAC to succeed. And so what SPACs have done in this new iteration I've seen is to try and bring some unique value to the structure that will make people want to be long-term holders. And so as what I've seen in the most recent iteration is that they're coming to the market with, for example, a reserve of cryptocurrencies in the fintech space. They'll be IPO'd with 50 Bitcoins or something like that. They're bringing together much higher qualities of team that won't necessarily depart. And they're coming up with new strategies for the equity instrument to be less likely to be dumped in the aftermarket. So that's why I think that they're not going to go away as long as there's capital chasing yield. It's just one of many tools in the toolbox.
Okay, super. Thank you so much. Now, to wrap us up, I wanted to ask both of you, what do you think makes a good IPO? Michael, you go first.
Thank you, Catherine. So, to me, a good IPO ultimately comes down to three things. First is credible growth story backed by real performance and solid management team. Second, strong governance and operational readiness, right? And a third, right market condition, right market timing. You can be the best in the world, you can be everything else, but there's no market. And so to me, the stars have to align for this to go. Once those three things align, IPO tends to perform very well, both at the listing and the years to follow.
Fantastic. Thank you very much. Louis, from your perspective, what makes a good IPO?
Well, as I've said before, you've got to have this function in place that looks backwards and looks forwards, and there has to be a consistent growth story. But I think what differentiates a successful IPO from a so-so IPO is that beyond those 8 quarters of growth, there has to be something so compelling that holders want to hold on to it. And I want to remember when my father, I give him credit for this, spotted NVIDIA some years ago. And I kept telling him to dump the stock, that it had so much growth that it couldn't grow anymore. And he kept saying, no, I see this rainbow. And the story was AI. And there's going to be so much more demand that an investor could literally see beyond 8 quarters and be compelled. And I think that's really the differentiator of a great IPO and a so-so one is having that. And it used to be, Catherine, international. Look at what I've done in the United States, and if I could just have the scaling capital to go replicate this in, let's say, in Europe, then wow, the world's my oyster. But I think private companies do that from the earliest stages now. So going international is no longer the way of showing the sizzle, if you will, beyond the 8 quarters. It's really got to be something in the product or in the market.
Okay. Fantastic. I like that. Can you demonstrate the sizzle? Thank you so much. That's unfortunately all that we have time for on today's episode of The Dealist. But I'd like to say a huge thank you to Michael and Louis, both of you, for sharing such wonderful insights into an IPO process.
Thank you, Catherine. Thank you, Louis.
Fantastic. Now, if you have enjoyed this episode of The Dealist, feel free to like, subscribe, or comment. We'd love to hear from you. Similarly, if you've got something that you'd like us to talk about, or if you have an interesting deal-making story to share with us, please reach out. The contact details are at the bottom of the screen. Thank you so much for tuning in today. Until next time, goodbye.